So do you buy into sell in May, go away?
Yeah, the old adage, sell in May and go away. And I think it's something about like you don't buy back until St. Ledger's Day, some horse race in September or something like that. Maybe that worked when everybody took the summer off. You just didn't want to have to worry about what was happening with your portfolio while you were on vacation. I don't think that's necessarily going to work this year. It's not that reliable to begin with, but we do sometimes see some volatility around the economic data. My team actually believes that we're still risk on, and we are monitoring things with data release by data release. Our biggest concern right now is that what if we get a little bit of disappointment with some of the labor market indicators? We know that the Fed wants to be on hold until we make substantial progress, whatever that means, towards closing that gap with the additional 8 million people who are still unemployed, who they'd like to see find jobs. That if we do see a slowdown in job creation, that while it's a good thing that the Fed might be on hold, it would probably be a pretty poor harbinger of what the rebound is going to look like.
What about the other side of the coin? Because just last week, we got U.S. personal incomes coming at a record high. This GTV chart on the Bloomberg showing how we advanced the most in monthly records back to 1946. So could you have some of the Fed members getting spooked, perhaps because of potential inflation?
I think some of them already are. Maybe they don't necessarily want to be too vocal about it, but on Bloomberg, I remember at the Fed Bank in Dallas, Kaplan was talking about, hey, we should be talking about tapering now, right? And Chair Powell insists, no, we shouldn't even be talking about tapering. But some of them want to have that conversation. And I think that, it's a little premature to think that inflation is going to start accelerating away from us. But you are going to have that divide, and maybe that's something that the market is going to need to wrestle with during the hot summer months, is that it's a divided Fed, and that divide is likely to grow. And the evidence is probably going to really initially support the idea that inflation is picking up, but really it's about, is it going to continue to accelerate, right? I mean, just because you have this one increase in the price level, you have a year-on-year increase in the price index that's inflationary. That doesn't mean that the 2022 versus 2021 numbers are going to reflect that same type of increase. And that's what the debate is about. And that's also what the confusion is likely to be about as well.
Yeah, well, as you say, though, the Fed showing no signs of even talking about it. Former Fed Chair and now Treasury Secretary Janet Yellen doesn't see inflation being a problem. So if we can assume the Fed's going to stay dovish for the foreseeable future, is there anywhere else to be but equities right now?
Yeah, on my team, we actually like to have it fairly well balanced with more equities and then also, let's say, with high yield. So, the more classic kind of risk on assets, the risky assets that are more geared towards growth, that's how we are biasing our portfolios. But now that yields have moved up, not to say that 1.62, 1.63% on a 10-year Treasury is anything to write home about, it does still provide some diversification benefits. So, if you think about government bonds, just classically, they provided good income and they were a good diversifier. Well, now they don't really provide all that great of income at all. But now that yields, at least U.S. government bond yields, have moved up a little bit, they will likely play a pretty good diversifying role in a portfolio. So we've actually moved a little bit more towards a balanced exposure, so geared more towards the cyclical risk on, but increasing that government bond allocation as yields have moved higher. We do think that we're likely to see yields end the year closer to 2% than, say, to 1%. So the risk is that you will see, government bond prices fall. But for the next couple of months, at least, we think that we could encourage a little bit of turbulence. So for us, adding some of that government bond exposure is a prudent way to add some diversification to a portfolio.
You mentioned there you do like cyclicals. I know you like industrials as well. What are your expectations around that sector? What's driving it?
Well, if you think about industrials, it really is almost like a junk drawer of different exposures in there. As far as you've got, companies that produce machinery, you have airlines, you have all sorts of different exposures in there. Very idiosyncratic. That's one of the things that we actually kind of liked about it, was that industrials itself is fairly diversified when you look underneath the hood at the different stocks in there. And so that sector we do think can continue to do well, just because of just how beaten down some of those industries were, and that it looks like as we're going through earnings season that they are surprising to the upside. It was one of the few sectors that there weren't sort of these knock out the lights expectations for earnings growth. It was hard to come by, right? Just because a lot of people were expecting this big rebound from the 2021 lows, so the year-on-year comparisons kind of creep in here. But the industrial sector, it seemed like there were fairly sober expectations, and they have proven that they've been able to beat on that. We think that that momentum can really continue as it draws investors' attention.